A price spike rockets upward, you click buy, and then instantly, the market violently snaps back down, leaving you trapped with a loss. The reason you are consistently losing money on these sudden reversals is because you are trading unconfirmed price action. By applying a strict protocol that requires waiting for candlestick closures, you can filter out these false moves entirely. Requiring a validated entry transforms trading from a stressful guessing game into a calm, methodical system of confirmed probabilities. Step 1 is identifying where the decision will be made. Open your preferred time frame and locate the most recent prominent structural swing high or swing low on the chart. Take your horizontal line tool and mark that exact peak or valley. This establishes a definitive battleground for the current market structure. This line establishes our conditional logic. Closing above it signals a buy, while failing to break it signals a short sell. Without establishing this rigid line in the sand first, any analysis of a single candle's movement is completely unanchored and meaningless. Now comes the active phase. As the market approaches your line, a moving candle will often push past it, creating a very tempting illusion of a breakout. This is the do not touch phase. You must keep your hands off the mouse until that specific candle's countdown timer reaches absolute zero. Watch what happens. Entering early, an aggressively rising price channel can suddenly collapse backward, leaving behind an empty trail where that momentum used to be. That empty trail is a wick. It represents attempted but ultimately rejected price action within that specific time frame. Acting on an open moving candle means betting your money on an unfinished story, which exposes you to maximum unnecessary risk. Once the timer hits zero, you ignore the wicks. You analyze the outcome strictly by looking at the final placement of the thick, solid body. Let's look at this chart side by side. On the left, we see a rejection. The wick pierced the line, but the solid body closed entirely beneath it. When this happens, immediately cancel any buy ideas and pivot to look for a short sell. On the right, we see confirmation. The solid body successfully pushed through the resistance and came to a rest entirely above the horizontal line. With a confirmed closure, you are now cleared to confidently map out a buy setup. The physical location of the closed body is the only undeniable proof of who actually won the battle between buyers and sellers. There is one final rule you must apply to prevent being manipulated by market noise, known as timeframe relevance. A common mistake traders make is identifying a key level on a 1-hour chart, but then dropping down to a 30-minute chart out of impatience. This chart shows the 30-minute view. Here, you see two consecutive candlesticks closing cleanly above the resistance line, creating a false sense of confirmation. But when we switch the label back to the 1-hour chart, those two smaller candles morph together into a single large candle with a massive wick above the line, and the body safely trapped below it. The absolute rule is this: the time frame you use to initially identify the setup level must be the exact same time frame you use to validate the closure. Mixing timeframes during execution overrides the original strategy entirely, turning a calculated logistical plan into an impulsive gamble. Now that you have these rules, you map out your trade position only after the proper timeframe closure is undeniably confirmed on your screen. First, you set your stop loss. Make sure it is tucked safely underneath the lowest point of the newly validated structural body. Next, set your profit target by projecting upwards toward the next major historical supply or demand level on the chart. Open your charting software right now and review your last 3 losing trades. Look to see if you are entering on unconfirmed wicks. Waiting for closures prevents pointless financial losses and ensures every single trade is backed by mathematically verified market momentum.